Welcome to today's program titled A Guide to Implementing the CARES Act and More, Relief for Employers and Retirement Plans Explained. At this time, all participants are in a listen-only mode. For those of you who are logged into the web presentation, you are encouraged to submit questions throughout the conference by typing them into the text box on your screen. For those interested in obtaining CLE credit for this webinar, an attendance verification code will be read during the presentation that will be required on the CLE attendance affirmation form. Please write this code down. It will not be reread, and it is required for CLE credit. Copies of the webinar recording and materials will be distributed to attendees in the days following the webinar. At this time, I would like to turn it over to Liz Deckman. Liz, you may begin.
Thank you. So good afternoon and welcome everybody to our webinar, A Guide to Implementing the CARES Act and More, Relief for Employers and Retirement Plans Explained. My name is Liz Deckman. I'm a partner at Seyfarth & Shaw's Seattle office, and I'm pleased to be joined today by my amazing co-presenters. We have assembled a terrific panel today here on the West Coast in both Seattle and San Francisco, and each member brings a different point of view that will help explain implementation questions relating to the CARES Act and other guidance. First, I would like to introduce my colleague, Ben Spader, who's Senior Counsel in Seyfarth's San Francisco office. Ben has many years of experience providing legal advice in the retirement plan area. Dina Herbelich and Brad Wall are CPAs and assurance partners at Moss Adams here in Seattle. We are excited to have Dina and Brad with us to provide tips and guidance from an accounting and auditing point of view. Last, but certainly not least, is Rob Dent, VP of Client Services at NWPS. Rob is also here in Seattle. I'm happy to have him on the panel because he will be giving us his insight into the CARES Act implementation from the very important third-party plan administrator's point of view. We have a full agenda today. As you can see, we will be tackling 8 different topics from our various areas of expertise. The CARES Act and related guidance provide a helpful, although complex, network of new rules and regulations. By now, many of you have made initial decisions regarding the CARES Act. This webinar is designed to help you navigate some of the issues and questions that will come up when you begin to implement and administer the new rules. The first few topics to be discussed apply to defined contribution plan types, coronavirus-related distributions, loan relief, and waiver of minimum required distributions. We will touch briefly on plan amendment requirements and the importance of keeping track of your CARES Act decisions, and then turn to defined benefit plan funding relief. Thank goodness DB plans were not forgotten in this round of guidance. We will also discuss some EBSA and Joint Department of Labor and IRS relief. And last, Dina will discuss certain facets of the Paycheck Protection Program. And if there's time remaining at the end, we will be taking questions. So at this point, I will turn it over to Ben to discuss CRDs. Ben?
All right. Thank you. Thank you very much, Liz. So the CARES Act was enacted on March 27, 2020, and was intended to provide economic relief and stimulus to Americans ravaged by the coronavirus. I will be discussing some of the retirement plan provisions of the CARES Act, or just CARES, or just the Act for short, including financial relief to participants in the form of coronavirus-related distributions, which I'll call CRDs for short, and coronavirus-related loan relief, which I don't have anything for short for that. Also, I'll talk about a strange tax break for those who don't need money right away in the form of a waiver of minimum required distributions for 2020, MRDs. I'll leave the DB funding issues for our renowned plan accountants at Moss Adams to discuss later in the program. All right, okay. First, we'll have some fun with coronavirus-related distributions. The principal concept to remember about CRDs is that they are designed to provide favorable tax consequences to plan participants who withdraw retirement plan funds to cover coronavirus-related expenses, and to allow participants to gain access to their money now. The CARES Act allows employers to amend their plans to offer early in-service withdrawals of salary deferrals. That is 401k money, for example. We'll talk much more later about this optional plan feature. So, what is a CRD? A CRD is a distribution from an eligible retirement plan, which we'll define, made on or after January 1st and before December 31st, 2020, to a qualified individual, which we'll define, in an amount not in excess of $100,000, which we'll also define. Now, a few quick points on what I just said. Because the distribution must be made before December 31st, December 30th is the last day a CRD may be made, just to note that. Also, for purposes of the $100,000 limit, the term employer, it's a $100,000 limit from the employer. The term employer means the employer maintaining the plan and those employers required to be aggregated with the employer. That is, all the employers in the employer's control group. A plan does not, importantly to note, have to aggregate unrelated plans and IRAs to determine the $100,000 limit. That's the participant's job. This is much like the rule for keeping track of 401k deferrals under 402G. That is, the plan only has to worry about the limit with respect to the plans in the employer's control group. So what is an eligible retirement plan? Well, they are IRAs, qualified plans of all kinds, defined benefit and defined contribution, or defined contribution and defined benefit, either way, 403B plans, 408B retirement annuities, and governmental 457B plans. Now, I have an asterisk next to IRAs to remind me to alert you that IRAs are generally outside the scope of this discussion and may have some different rules in certain circumstances, so I just wanted to remind you that's beyond the scope. But you're welcome to get in touch with any of us if you have any IRA questions. In any event, what is a qualified individual? Qualified individuals are defined on this and the next slide, but in some, it is a participant who either has or had the coronavirus, or whose spouse or dependent has or had the coronavirus, or a participant who has experienced adverse financial effects as a result of the coronavirus, or their spouse or other household member experienced financial difficulties as a result of the coronavirus. And that is covered on these two slides. But at this point, though, I'd like to reiterate that a CRD can be any distribution from any qualified plan in 2020, except for December 31st, remember, to a qualified individual of $100,000 or less. Remember, the focus of CRDs are participant tax breaks, and to some degree, access to funds, which we'll talk about on the next slide. Now, as I just mentioned, the CARES Act offers a special distribution opportunity for plan participants to receive penalty-free early distributions of their salary deferral contributions. For example, an employer may, but does not have to, expand the distribution options under its plan to allow an amount attributable to elective deferrals, 401k, for example, to be distributed before age 59 and a half while in service. So, the special rule is applicable to 401k, 403b, and 457B plans, provided, in all caps, the employer elects to allow these special deferral distribution rules. Thus, it is optional for a plan to elect these rules and put them in place. It is not elective for the participant. The participant can't simply choose to withdraw at a time for which it would otherwise be impermissible. All right. There is no special early distribution rule for defined benefit plans, money purchase pension plans, profit sharing contributions, or matching contributions. For DB plans, you just have to be at least age 59 and a half, and the plan must allow otherwise for in-service payments. And 59 and a half became a first effective under the Secure Act. For profit sharing or matching money, there is no special rule because these amounts can already come out of the plan at almost any time. So, if an employer wants to permit these amounts to leave a plan sooner than the plan already provides, like immediately, the plan must be amended, which brings me to something a bit peculiar. The deadline under CARES for amending a plan to allow early salary deferrals is generally the end of the 2022 plan year. Liz will explain more about the normal amendment rules shortly. But what is the deadline for an amendment to make profit sharing and matching distributions earlier than they are now allowed in a plan? Also, what about amending a defined benefit plan for the age 59 and a half in-service distribution in connection with being a qualified individual, say? It seems pretty clear that one of the intents of the CARES Act was to encourage employers to make retirement plan money available to participants sooner if they have been affected by COVID. Nonetheless, I question whether there may be a hole in the statute, which you see in many new laws, or whether the amendments I just described must be adopted before the end of 2020, like other discretionary amendments. I believe we need guidance on this issue, and I'll do my best to get it to you. Stay tuned. Okay, in any event, any distribution of these amounts can still be a CRD if they are paid to a qualified individual, are less than $100,000, and then the favorable tax treatment, even distributions from a defined benefit plan, still applies. And we'll discuss those special tax rules in a moment. Now, to reiterate, there is no requirement for plan sponsors to adopt special distribution provisions, and any distribution from a qualified plan, including DB plans and plans that do not adopt the special distribution rules, can be a CRD and receive favorable tax treatment on an individual's federal tax return. All right, now we'll talk about other issues and review a little bit. First, certain distributions you should be aware may not be treated as CRDs, such as corrections under Section 415, 402G, and the ADP test, for example. A mandatory withholding is not applicable, and we'll speak about that in a minute. Employers may choose whether to treat distributions as CRDs. All of this is optional. We already covered that. The aggregate limit of $100K must be monitored within the control group, and we talked about that a bit. Now, reliance on employee certification. This is important. The plan administrator may rely on an individual certification that the individual satisfies the conditions to be a qualified individual in determining whether a distribution is a CRD. unless the administrator has actual knowledge to the contrary. This is limited to situations in which the administrator already possesses sufficiently accurate information to determine the veracity of the certification. In other words, bold highlight here, there's no duty to investigate, and that's important to understand. Basically, take the participant's word at face value. In fact, Notice 2020-50, the IRS guidance on this issue, contains a sample certification which basically says in its entirety, I certify that I meet at least one of the following conditions, signed plan participant. So it isn't a high threshold, and as an administrator, your duty is a fairly low bar. Okay. Now let's get into those tax relief issues. CRDs are eligible first for an exemption from the 10% early distribution tax. Next, eligible for a 3-year income inclusion option, meaning the CRD is taken into income all in year 1 or equally over 3 years. And lastly, a 3-year rollover period. In addition, re-rollovers are permitted within the 3-year period from the date of the CRD, even if the full amount is taken into income in year 1. But if you roll something back in year 2, after you've already taken into the income in year 1, you'd have to amend your tax return. A plan administrator accepting the recontribution of a CRD must reasonably conclude that the recontribution is eligible for direct rollover treatment. And in making this determination, the administrator may rely, again, on the individual certification unless the administrator has actual knowledge to the contrary, meaning, again, no duty to investigate. Regardless, if a plan does not accept any rollover contributions anyway, the plan is not required to change its terms or procedures to accept recontributions of CRDs. And lastly, all CRDs must be treated consistently. That is, either all distributions must be included in income over a 3-year period, or all distributions must be included in income in the current year. You can't include half of it in year 1 and a quarter in the next 2 years. Equal or all. All right. As for rollover issues, the eligible rollover distribution rules are not applicable. That means the plan is not required to offer participants a direct rollover of a CRD, not required to provide a 402F notice or withhold the normal 20% of the distribution. A CRD is subject to the voluntary withholding rules, which is 10% by default or can be 0 at the election of the participant. But remember, this only applies if the plan chooses to adopt the CRD relief. If the plan does not, then the normal rollover rules apply. Lastly, we have tax reporting. An eligible retirement plan must report the payment of a CRD on Form 1099. And this reporting is required even if the qualified individual recontributes the CRD to the same plan in the same year. Now, I know that Brad and Rob have some comments on tax reporting.
Well, thank you, Ben. This is Brad Wall. All right, so many of you are aware that retirement plans that have over 100 participants require an audit, and many of you may be going through your audit right now. So the question is, well, what does this CARES Act stuff, how does that impact the audit that's going on now? Well, the auditor will obviously be interested in whether or not you plan to adopt the CARES Act provision and issue CRDs, as we've already discussed. Now, from the auditor's perspective, the new plan provisions allowed by the CARES Act are considered what we would call a subsequent event for the purpose of the plan's 2019 financial statements. So it's quite possible that those of you who are involved in your audits now, it's possible that your auditor may be asking for copies of notices that were sent to participants, because those notices will be explaining what provisions and amendments that plan sponsor will be adopting. Understood that the amendments are not out yet, and in fact don't even have to be legally amended and made part of the plan until the future. So, to the extent that the new provisions are significant to the plan sponsor may want to disclose these in the 2019 financial statements as a subsequent event footnote. That's really up to the plan sponsor. If they think it would be helpful for readers to understand that, we would probably encourage that. But if that is going to be done, the auditor is going to probably request that the items disclosed related to the CARES Act are put in a management representation letter so that management is representing to the auditor that they understand their responsibility to amend the plan in accordance with IRS guidelines in the future. So basically, the auditor is asking the plan sponsor to essentially promise that they're going to be ultimately amending the plan for the items disclosed. So Rob, what are you seeing from the plan sponsors that you work with and their plans regarding these amendments?
Yeah, what we've been doing, our approach has been to reach out to our clients. We've been in contact with them, and we've made it a point to document what their choices are. Typically, it will be in the form of an email getting back to us and saying, hey, this is what we want to do, or we don't want to do anything at all. We've had to document all that because we've also prepared participant memos to communicate what changes have been implemented or what choices have been implemented. So we do need to track all of that. And furthermore, we need to track it because, as you said, the amendments aren't really out now, and it's going to be a little while, or you have a while to amend the plan. So we need to keep track of all that stuff so we know what to do when the time comes. At this point, we've not prepared any amendments ourselves, and nor have we seen any amendments prepared for plans that use their own ERISA attorney. Ben, are you going to take back over on this slide?
Sure. All right. Now that we are moving on, and that was pretty deep, so we'll lighten things up with the discussion of coronavirus-related loan relief. So, the CARES Act increases the loan limit and provides an extension of certain loan repayments, but only to qualified individuals who are the same ones we just spoke about. And again, these provisions are optional. Also, just like CRDs, the plan administrator may rely on an individual certification that he or she satisfies the condition to be a qualified individual and therefore qualifies for the special treatment for loans under the CARES Act unless the administrator has actual knowledge to the contrary. The increased loan limit is the lesser of $100,000 instead of $50,000, or 100% of the participant's vested account balance instead of 50%. The new loan limit applies only to loans issued from March 27th through September 22nd, 2020. Now, the due date for any repayment of a loan to a qualified individual is extended for 1 year if the repayment with respect to such loan occurs during the period beginning on March 27, 2020 and ending on December 31st, 2020. Now, if you read this in the statute, you may not have known what it means. I don't think anyone was able to do the math precisely based on that phrase in the statute. Moreover, recent guidance in the form of IRS Notice 2020-50 proves there actually was no precise meaning. That is because that notice gives us a safe harbor, which we can apply as opposed to a rule that we can apply. So the safe harbor here is we suspend any loan payments due from the qualified individual from March 27th to December 31st, begin repayments on January 1st, 2021, and re-amortize through the 1-year period following the original due date. Regardless, other reasonable methods may be used, and we could discuss this further offline if anyone would like to dive into the calculus of other methodologies for making repayments of loans. And I know, again, Brad and Rob wanted to chime in.
All right. Thank you once again, Ben. As I previously discussed, the CARES Act will probably not have a lot of impact on the audits for the 2019 year, which are going on now. At best, it could be a subsequent event disclosure. However, the question is what's going to happen next year when auditors are auditing 2020? Well, understand that each auditor will probably have a different approach, but we would imagine that there's going to be a lot of additional testing because we want to make sure that the CRDs or loans are being issued in accordance with the rules set forth. So auditors are likely to select multiple distributions and possibly multiple loans. You know, each auditor would probably look at, well, how many CRDs were issued? You know, if there was 100, they might want to, you know, test a certain number. If there's only 1 or 2, they may, you know, decide to, you know, just test those 2. So it's going to be up to each auditor. And the same is going to be with the loans. So the main thing is, the auditor will want to see, did the plan sponsor do their due diligence, especially in approving the loan or the distribution under the provisions of the CARE Act, so that only qualified individuals receive the distribution. That's very important, that it be verified that anybody who got money from the plan is truly qualified under the various requirements. So Rob, are you having clients ask you how to go about and do this?
Yeah, our approach on this has been, you know, the main thing is that the participant just has to certify that they're a qualified individual, as Ben defined earlier, you know, unless, of course, the plan sponsor has actual knowledge. So what we've done is created a special, what we call a CARES Act distribution/loan form, obviously modified depending on which provisions the client has chosen to implement. But on that form, there is certification language in there, and so when they sign off on it, they do say, you know, I certify that I satisfy the following requirements to be a qualified individual. We've also done the same thing, maybe in a little more of a generic form, certification form, for the loan suspension part of it, if the participant is going to have their loan payments suspended. And back to you, Ben.
Thank you very much. Okay. Lastly, move ahead here. If you put up with me for just another couple of minutes, I'll speak briefly about the 2020 waiver of minimum required distributions, just because we have a little bit of time for some more fun. Okay. Now, the CARES Act provides, as a basic rule, that the minimum distribution requirements of 401(a)(9) do not apply to applicable plans, quote unquote, for 2020. Applicable plans are defined contribution plans, not defined benefit plans, for your notes. 403B plans, governmental 457B plans, and the outside the scope of our discussion, IRAs. The 2020 MRD waiver applies to anyone who has already started receiving MRDs in a prior year and would have been required to receive an MRD in 2020 but for CARES, naturally. Anyone who actually received already an MRD in 2020 for any reason, that was in fact an MRD, and anyone who could have received an MRD in 2020 if their required beginning date is April 1st, 2021, even if they don't even receive that payment until 2021, because it was actually for 2020. On the administrative compliance side, we see an analogy to the CRDs. Amounts that would have been MRDs in 2020, but for the CARES Act, are not treated as an eligible rollover distribution for purposes of 401(a)(31 relating to the offering by the plan of a direct rollover, the rollover notices under 402F, and the mandatory 20% withholding under 3405C, just like I mentioned earlier, similarly for CRDs. Now, buckle your seatbelts for a minute while I briefly visit the stratosphere, because the question as to what can actually be rolled over can be complex when you drill down to the microscopic level. But what can be rolled over as an MRD? Well, we know any amount that would have been an MRD in 2020 can be rolled over because MRDs are not typically eligible or ever for a rollover treatment. But now that they're not MRDs, they are likely are, particularly from a defined contribution plan. And that includes periodic payments you might have been receiving designed to satisfy the MRD rules. But those periodic payments that you receive in 2020 can be rolled over. The rest of the guidance is actually unclear, but I submit to you that my slide here covers all the permutations. We'll just have to see if we receive any further guidance on that issue. It becomes particularly complicated if you are in the rare case of having a required beginning date of April 1st, 2021, and trust me, you can only have that if you actually are over 70.5 and retired in 2020. So let me know if you ultimately agree with the items on the slide, but I don't believe it's clear at the moment. So in any event, let's see, coming down to earth a little bit, I have some good news besides the fact that, I'm almost done with some of these deeper things. Any payments that can be rolled over because of the MRDs that were waived in 2020, which are most things. This is generally not a complex area. They have a deadline to roll over that's not before August 31st, 2020, and that is really good news. This means that if you took a distribution early in 2020 that would have been an MRD, you have until August 31st to roll it over rather than the normal 60-day rule. If you take a distribution today, you have the full 60 days, which can extend beyond August 31st. Finally, for the sake of time, further guidance concerning the waiver of MRDs in 2020, including all the questions listed on this slide, can be found in IRS Notice 2020-50, or as I mentioned before, you are welcome to give us a call if you have any questions. So without any further ado, I'm going to pass the torch back to Liz. Thanks.
Thanks, Ben. We are going to now move on to, again, some good news for all of you, and that has to do with the plan amendment due dates for CARES Act changes. As you can tell already, implementing the CARES Act requires you to keep track of a lot of different moving parts. And each one of us on this phone call will need to know what your elections are for different reasons. But for us, as attorneys, we're going to need to know what you've elected so that we can draft plan amendments for you. You will want to be able to use the memos and emails that Rob has told us about that they are distributing to their clients to document choices that you've made. And if you haven't done so already, I would really urge you to put together a list of the CARES Act elections that you've made so that you can keep them handy, and you're going to need them in the future. So something for you to think about there. As you can see, there's a delayed deadline. Normally, changes that you make to your plan features would need to be done by the end of the plan year in which you make them effective. They're just sort of administrative plan changes. But here we have an extension, and it's the last day of the first plan year beginning on or after January 1, 2022, or December 31, 2022 for calendar year plans. And then for governmental plans, they have 2 more years. The last day of the first plan year beginning on or after January 1, 2024, or December 31, 2024 for calendar year plans. Another helpful tip, the IRS did give us sample minimum required distribution amendments. That was in Notice 2020-51, and they will be helpful in the future when we're drafting required minimum distribution changes for CARES Act. But at this point, I'm going to now turn it over to Dina to discuss DB plan funding relief.
Thanks, Liz. So the defined benefit plans, as Liz pointed out earlier, were not left out of the CARES Act. The CARES Act extends to January 1st, 2021, the due date for any minimum required contributions that would otherwise have been due during 2020. And that delayed funding relief is applicable for any contributions that would have been due in 2020, regardless of whether that funding was attributable to 2019 or to 2020. And it's nice to have that relief, but you won't get the tax deduction if you're an employer unless that payment is made by September 15th or whenever your traditional payment deadline is in order to take that tax deduction. So there's some tax planning considerations versus cash flow considerations when you're thinking about these decisions. Just as an aside, there are other tax planning opportunities from the various legislation that's come out recently, like NOL carrybacks and qualified improvement property deductions, lots of things to be thinking about there. But for this purpose, if you're looking to deduct that contribution for your 2019 taxes, you need to make that by the extended filing date of that tax return. And then the relief also comes with some other reporting challenges when you think about your Form 5500 for 2019, Schedule SB, and because we're talking about single employer plans, the Schedule SB would be relevant, and also Schedule H of Form 5500. So if you assume that your company would normally make the final 2019 contribution by September 15th, that amount would be used to determine your PBGC premiums, for example, that you calculate before October 15th, and then also to report as a contribution on the 2019 Form 5500 as a contribution receivable. The actuary, you recall, would certify that those payments had been made on the Schedule SB if they were made before September 15th, time for the October 15th 5500 filing deadline, assuming you have appropriate extension. So if that payment isn't made in time for that filing, the question is, what is going to happen with the Schedule SB and the Schedule H? And I know the actuarial community is hoping the IRS will give some guidance or relief on the 5500 filing. Department of Labor also would have to be on board with that. But it doesn't look like that's happening. there'll probably be some other sort of compromise on how to complete the Schedule SB or file it and amend it later. It sounds like there's a lot of buzz about this in the actuarial community. And I think for purposes of finalizing the 2019 audited financial statements and Form 5500, at least Schedule H, you'd want to kind of continue to work through that now so that you're ready to kind of pivot if new guidance comes out, or be working with your auditor and your actuary now to be thinking about how that reporting would look. Just as an aside, for the audited financial statements, you typically would report a contribution receivable. Again, this is the plans, the defined benefit plan financial statements that's filed with Form 5500. You would typically report a receivable for any 2019 contributions that haven't been made by year end. By 12/31/19, you would accrue those as a receivable. And so the question sort of becomes, well, A, does the company have the funds to make that payment? If there's liquidity issues or cash flow issues with the organization, you might need to think about an allowance for doubtful accounts on that receivable. And also, what is this receivable for? Is it your minimum funding? Has it been deducted for tax purposes? You'll need to be evaluating the audit. The auditors will be evaluating the evidence sort of supporting that receivable. So a lot of interesting things to think about. I guess some good news out of all of this also is the AFTAP for 2019 can be used for 2020, so that will help plans. I think, if you think about how the markets, your AFTAP certificate for January 1st, 2019, you can carry that forward into 2020. Well, at the beginning of 2020, the markets were still in pretty good shape. Your assets were probably still fairly healthy. But I think if you have maybe a March 31 year end with an April 1 beginning of year, your assets were probably pretty low. So having this AFTAP carryover from 2019 is probably a welcome event for you. And then, Liz, anything you wanted to add about funding relief here?
No, I think I just wanted to reiterate what you just said, which was the welcome relief on the AFTAP certifications. Maybe then I will segue to other welcome relief that we've had recently given to us by the Department of Labor. We have EBSA Disaster Relief Notice 2020-01. The CARES Act permits the DOL to extend certain deadlines for up to a year in the case of a public health emergency such as COVID. And the department took advantage of this right in this notice. I think they were mindful of the hardships that many of us have faced during the pandemic, especially with people administering plans if they're working remotely, if they're sick, if they've gone on layoff or furlough. So basically, this notice says that there is not going to be an ERISA violation if a notice, disclosure, or document is not timely furnished, and this is a long period of time that you have during the period of March 1, 2020 through 60 days after the end of the national emergency, provided that the plan acted in good faith and gave the late document as soon as reasonably practicable. So this is going to relate to such things as annual funding notices, summary annual reports, summary plan descriptions, those kinds of things. The guiding principle is that you're supposed to be acting reasonably and prudently in the interest of your workers and their families who rely on the benefits for their well-being. This means you can't ignore ERISA's rules, but you have to strive to comply in the best way you possibly can in these circumstances. Perhaps we have a kindler, gentler Department of Labor right now. As you can see, there is also some specific guidance given on some of these different types of notices and things that happen that could be late. But the one that I wanted to discuss in more detail are the late participant contributions and loan repayments. As you may know, normally these contributions and repayments have to be forwarded to the plan on the earliest date on which they could be reasonably segregated from your general assets. but in no event later than the 15th business day of the month following the month in which the amounts were paid or withheld by the employer. Well, with all of the havoc that the coronavirus has played in our lives, some employers have found it difficult to continue to forward contributions based on the same schedule that it had been following in the past. For example, if it would normally take 3 business days to forward the contributions, then it might be now that there is a circumstance where it would take 4 or 5 business days. So based on this notice, the DOL will not solely based on a failure attributable to COVID, take enforcement action with respect to a temporary delay in forwarding contributions to the plan. However, you do, as I said, have to comply to the extent reasonably practicable. Now note, this relief only applies to employee contributions, like, for example, 401k contributions. It does not apply to employer contributions, and there is no relief from participant complaints that they received late contributions. A side note, if you do make a late contribution, there is a Department of Labor program, the Voluntary Fiduciary Correction Program, that allows you to correct them with department approval. And even if you don't take advantage of that program, you still should correct late contributions. And basically, you determine the lost interest or earnings due to the late contribution, and you need to contribute those amounts to accounts, participant accounts. There would also be an IRS excise tax. That's because the late contribution is considered a prohibited transaction. So, helpfully, the DOL has also stated that you can, in good faith, use electronic communication if the plan reasonably believes that the participant has effective access to electronic means of communication, like email, text messages, and company intranet sites. And that is also very welcome relief. The Department of Labor has given us also other final regulations on electronic communications, but this is a very, very good step and I think in the right direction. So, Dina, I think you wanted to make some comments here on perhaps audits, late audits, and maybe partial plan terminations.
Yeah, I'll talk about maybe the timely deposits and partial plan terminations, and then kick it back to Brad on late audits. So the auditor is still going to ask for your schedule of participant contributions. Essentially, your auditor typically will ask you for a list of every pay period and the date that the contributions were withheld, and then the date they were deposited to help you evaluate your reporting requirements for delinquent participant contributions. And that procedure won't change. I would just encourage employers to track those deposits contemporaneously with making the deposits, so that it's clear that you've made your best attempt to deposit those funds as soon as administratively feasible, and document the facts and circumstances around each pay period. You know, which pay period had turnover in payroll, which is the date that you went to a remote work environment, what's the date that the person was sick. You know, there's all of these reasons, and I think the Department of Labor has traditionally been very facts and circumstances focused when they look at these delinquent contributions. Pay period by pay period, the circumstances could change, and I imagine that's changing even more with the pandemic. And then the partial plan termination situation, you know, this is a kind of a loose definition I'm going to give you, but essentially when you have more than a 20% reduction in force, the IRS would look to the plan sponsor to treat that as if there was a partial plan termination for the affected participants. So if you lay off 30% of your workforce as a result of the pandemic, that seems pretty clear. It's more than 20%. It happened pretty quickly. And really the impact to those participants is that you would fully vest them in their accounts. If they were not fully vested already, you sort of treat them as if that plan was terminated for them. Your employees that are continuing with you, you would not receive that same treatment because they'll continue to vest as they work. There's some nuances here because with the pandemic, there have been a lot of furloughs where participants remain benefit eligible versus outright layoffs. So there's considerations there. And the other thing is, I know a lot of companies don't think that this is behind them yet, that maybe some initial decisions that they made to maybe have a 5% or 10% reduction in force might change in a year as the effects of the pandemic and the recession trickle down to different industries or continue to impact the industries already. You might over time have a 20% reduction in force. So you do need to track that for purposes of these partial plan termination rules, especially if there's a vesting schedule within your plan. For participants who are already 100% vested, there's not as big of a concern. And I think I'll just kick it back to Brad. We were talking about timing earlier, and sometimes the 5500s are complete, but for whatever reason, the audit is not complete by the time it's due. And I think we'll see more of that now, especially if there are reductions in workforce that are helping plan sponsors get through that process. So, Brad, what are you seeing as options there?
Well, as most people probably already know, that the first deadline for December year-end is Friday, July 31st. And then, like any government filing, you can get an extension of 2.5 months, which takes the extended deadline out to October 15th. Now, we haven't heard anything about the Department of Labor, the IRS, looking to delay this filing, the extended filing date, like they did with the 1040s. So we are operating under the expectations that everything's going to be due by 10/15 at the latest. Now, as Dina said, there might be some challenges in getting the audits done. So the question is, what does the plan sponsor do if the 5500 is done, but the financial statements and audit are not? So there's really two camps on this one, and there's not one camp that's better than the other. One camp is that you do not file the 5500 until the audit is complete, and then you can file it later under some of the Department of Labor's delinquent filer voluntary compliance programs and pay reduced penalties. Another camp feels that you should file the 5500 without the audit, but include some sort of indication that the audit is in process, since you are, and that's important because technically the 5500 is being signed under penalties of perjury, and that you might want to consider probably attaching a notice, especially in the circumstances we are now. You could say, due to the COVID and various other reasons, we have not been able to get our audit completed on time. Ironically, I actually have a current client that's going through this. Last year, we weren't able to complete the audit by 10/15. And within 45 days, late November, that client got a letter from the Department of Labor. And what that was is basically the Department of Labor said, you have 45 days to fix this, which means get their audit completed. They also showed that they were fining the plan sponsor $150 per day, and they take it back to starting August 1st. So they don't allow for the extended due date. So as you can see, that starts adding up. Well, they did not respond to their first letter. So the Department of Labor sent a second letter, and unfortunately, that one came in mid-March, went to the offices, which no one's there, so they didn't find that one either. And then finally, they got another notice in May, which had the big fine on it. The irony of this whole situation was that we completed the audit within 45 days, but for whatever reason, the client did not file it. So now they are in a lot of having to get attorneys involved to help them unwind this thing and fix it. So that's it. What's the next slide, Dina, I believe?
Actually, I think it's me, but I think that actually,
Okay.
Brad, brings up a really good comment, which is in this day and age when people are working remotely, you need to make sure that someone is in place on site looking for IRS, Department of Labor notices that might be coming in. And it will be interesting to see, as I said, the Department of Labor is trying to be helpful, but it will be interesting to see how helpful they end up being in situations like that. And one last bit of joint DOL and Treasury or IRS relief, and that is that that DOL has recognized it's difficult to navigate ERISA claims procedures and timing rules during the pandemic. And so as a result, ERISA-covered plans like 401k plans, defined benefit plans, they must disregard the period from March 1, 2020 until 60 days after the announced end of the national emergency, or maybe a later date, depending on what we hear, in determining the time to file a claim, appeal a denied claim, or request information to perfect an incomplete claim. So obviously there is going to be a long period of time where claims are sort of held in suspension, and we'll see how that all turns out. So at this time I'm going to read the CLE, Continuing Legal Education Code, and that code is SS 9019. SS as in Sam 9019. Moving on to relief for Safe Harbor 401k plans. Many of you may have Safe Harbor plans, and a Safe Harbor plan is one that requires an employer to make a set amount of matching or non-elective contributions to the plan each year. Lots of employers were asking for relief for having to make these kinds of Safe Harbor matching or non-elective contributions. The reason that this is important is that Safe Harbor plans are excused from having to run annual non-discrimination tests like the ADP and the ACP tests. But one of the things that you have to do in order to be excused from those tests is that you have to send a notice to participants prior to the plan year as to what the contributions will be. And once that notice is given, there generally can be no changes to them unless, and these are in the regulations, the employer suffers an economic loss or the notice reserved the right to make a change. Now, obviously, a lot of employers really didn't know that they were going to be having such an economic downturn because nobody could have predicted this pandemic. So the IRS has given us some guidance, and it says you can actually make a change to your contributions, your employer contributions to Safe Harbor plans, as long as there is an amendment that you adopt it between March 13th of this year and 8/31 of this year, but no later than the effective date of the date that the contributions are going to be stopped or suspended. And then for matching contributions, you can update your notice, and you have to give that at least 30 days prior to the effective date so that people know that the matching contributions are going to be stopped or suspended in the future. For non-elective or profit-sharing contributions, the updated notice only has to be distributed by the end of August, so it can be retroactive. Now, note, this would require you to pass ADP and ACP testing for this year. And again, you will have to have a plan amendment. So you will have to plan ahead, but you do have those options now when you wouldn't maybe before. Another bit of good news is that you can, according to the notice that was given, suspend contributions to highly compensated employees without losing safe harbor status, provided that you give notice to the highly compensated employees 30 days before the effective date of the change. And that has nothing to do with COVID. That is just simply a clarification or confirmation of how people have been reading regulations already in existence. So Rob, have you seen people be interested in changing their safe harbor contributions at this point in time?
You know, surprisingly, we have not seen a large number of clients suspending their safe harbor contributions. We've had, a number of inquiries, and really just kind of a handful of clients that have done this. You know, I kind of suspect that the PPP loans are really helping out with that. They're kind of keeping them afloat. But it's going to be interesting to see what happens when that money dries up. We'll have to see.
Okay. Well, speaking of PPP, maybe we'll turn it over to Dina for our last topic of the day.
Yeah, thanks. And I realize we're at the top of the hour, so I'll understand if you pop off. But I do, and I really just have a couple comments here. You know, the PPP loan on its own is not necessarily related to retirement, but we figured that the folks attending this call might have been involved with collecting information in order to apply for the loan to begin with, and probably will be involved with the data collection when you ask for forgiveness. So I just included a few bullets about the Paycheck Protection Program Flexibility Act, which was signed on June 5th into law. And it gave a lot of welcome relief, I think, to employers, reducing the amount of the loan that needed to be used to pay for payroll expenses, increased the time period that you could use the funds. There's a few safe harbors that allow you could be a little more flexible on if you can't rehire employees or can't rehire workers for some reason. And I do want to point to the last bullet here as a reminder, because there was some confusion when the PPP loans first came out. But as an employer, even if you have a PPP loan, you can defer payment of the employer's portion of FICA taxes, which is an excellent cash flow strategy. That money will be due eventually. Don't forget, you have to pay it back, pay the government. One half will be due at the end of 2021, and the other half will be due at the end of 2022. Originally, there was some thought maybe that if you had a PPP loan, you couldn't defer these taxes, and then it was clarified that you could defer up through the point where you were forgiven, but now this Flexibility Act has clarified that you can defer through the end of the year. Just don't forget to accrue that as a liability, so you pay it back. So Liz, I'll turn it back to you to close us out.
Okay, well, I think we've now come to the end of our webinar. I wanted to thank everybody for attending, and I will now turn it back to Jenny to sign off.
Thank you. This concludes today's webinar. Thank you for attending.